And that's where we start with the market rally that no one can seem to touch. Not the Fed, not trade wars. Now fears of an earnings recession are being washed away. The S&P 500 closing at its highest level since September 20th. The Nasdaq joining in on the action, also closing at a record high. And the market has been on what it seems like an unstoppable run off the December low. So is the party just beginning? What can you still buy? Guy.
First of all, I love that song. It's like
really?
Yeah.
Makes me want to get out of
Do
my
you have a pair of the MC Hammer pants?
He's wearing them now.
That's
I mean,
that's
the
Hammer,
cameras
right?
can only see.
Hammer time. Yeah.
It's fantastic. It's like 90s-ish, is that right?
I think it is.
What can you still
19,
buy? Well,
not
clearly
18.
you can't go to Blockbuster or Tower Record and buy that album, although I did back in the day. But what you can still buy, in my opinion, is healthcare. You look at Eli Lilly's going from 132 down to 117. They report on April 30th. Pfizer from 44 to 39. Merck, same way. You've seen a bounce in UNH. I think healthcare has been taken to the woodshed on the back of a lot of rhetoric that I think will go away. Some of these tech names, crazy. Xilinx reports tomorrow. They better crush because this stock has gone from basically 90 to 137 in a straight line. So I'd be a little leery there. However, I do think healthcare has been beaten up for the wrong reasons.
You know, guys, some might say that this market is too legit to quit.
Oh,
Really want to kind of tie this together. Unless, you know, Can't Touch This was late 80s, not 90s.
Oh, sorry.
Here's the thing, okay? And this is going to go back to these mega caps. Obviously, there's been some great rotation. There's been some of these groups that we did not expect to kind of power us back to the prior highs have done it. I got to tell you, though, you got to go look at the Apple, the Google, and the Amazon, and forget the AMO MAGA, okay, because Microsoft has already made those highs. You know, you have these stocks that have already come back 40, 45%, I think Amazon and Apple, and you have to ask yourself, after a 24% reversal, V-reversal in the S&P 500, what is the thing that catapults us above those prior highs in a meaningful manner? And I'm just telling you, when you look at Amazon and Apple, they still have some room to get back to their prior highs, so I just don't see that as the thing, the catalyst to take us further. We're going to get Google on Monday, we're going to get Apple on Tuesday. I think those are going to be really important dates for this market high.
Well, if you get decent earnings and you get sentiment in general, you look at something like the City Economic Surprise Index, that is at all-time lows. So sentiment, what people are expecting out of this market are very low. I can come up with a bunch of different scenarios, oil, dollar, all these things that are headwinds, but the bottom line is the market just doesn't care. It just keeps going up. So maybe this is a blow off top, maybe this is a melt up, whatever term you want to use, but I'd much rather be selling into the strength than trying to initiate a new position here.
I agree. I mean, you know, my long bias, it's always how I'm going to be positioned, but I feel like some of these names have run up a lot. Alphabet, my biggest position, I actually sold some upside calls today. It's run a lot. It actually did touch an all-time high today and then fell off a few points. It closed a few points below that. You know, I probably would look to sell some other calls and other things, even something like JP Morgan, although the upside calls don't really have a lot of juice in them. But I feel like I'm not surprised that the first quarter was decent for companies, you know, but I feel like any sort of expectation that earnings would disappoint is kind of out of the market now. And in fact, so as the bar gets higher, even if you report good earnings, it's hard to beat. So I'm inclined to sort of be selling some upside calls against things.
I have a question.
I like what she wants to do.
When we talk about the run, you know, overdone run, you know, it's come a long way. Are we talking about since December lows? Because some could argue that we should have never gone down to the December lows.
But even take it from January 1. We're up 17%. That's a good year.
Well, January 1 wasn't much off the December lows.
That's true. All right. But still, I mean, we're 23% off the December lows. I don't know. I just think up 17% for a year is a good year in anybody's book. So
I think Mel
maybe it goes higher.
Mel makes a good point. When you think about the start of January in 2018, we had this market that was just on a runaway. Remember, we were talking about in the third week of January 2018, up 7-8%. Yeah. Can this continue to go here? We had a 12% correction, then we had a 20% correction. Now we're back at those levels here. And you say to yourself, is this where we were supposed to be with those tax cuts, with all this pro-growth sort of stuff? And are we set for another leg of this bull market? I think that's really your question. If that is your belief, then you do want to rotate rotate into some things like bank stocks. I know you guys have been all over that. I think some of them did pretty well after their Q1 results. Some are kind of stuck in the mud. But if you think that Larry Fink from BlackRock said last week, we're going to have a melt up, then these banks will start to participate. Obviously, the yield curve is pretty important here. It's still flat-ish. It doesn't really move from this mid 15, 16 basis point sort of level, and that could become a headwind. But that would be the one area where I'd say if you're in that camp, that's where you go.
I mean, I ask this because if you take a look at what brought us to the December lows, there are a lot of concerns that seem to have been resolved, right? We had the Fed pivot. We have now growth evidence in China and around the world. We thought everything was going to grind to a halt. It has not. So if we back to those levels, and we're just above those levels, where are we now?
So Europe is less bad than it was. The rate of change is getting better, but it's still miserable. Chinese have thrown a ridiculous amount of money at their economy. I think their stock market's up 34% or so from that low that they made. It's interesting, quickly, January 2nd was a very fascinating show. We did a 2-hour show, and Dan Nathan, everybody, always bear. He's not always bearish. Actually, on that day, he said, if you recall, this sets up really well for the bulls into earnings because of the huge sell-off we've had, and we've lowered the bar. And he's been exactly right. So he talks about the bar being raised now. I think you should listen to him, number one. Number two, you're right. We are back where we were basically in September. The move from March to September in the S&P was from 2,600 to 2,900 in a straight line. We're right back there now. So effectively, we were where we were in the fall. I still think, earnings are great. Earnings aren't great. Earnings are fine, right? I think that's really people are looking for a reason to get long this market, and they think the Fed has their back. I'm not confident of that. But what I will say in terms of what you can still buy, defense stocks specifically, look at Lockheed Martin today. Huge move to the upside. Have I missed it? No, you haven't missed it. There's probably still another 10 to 15% to get us back to where we were in the aforementioned fall.
Why don't we want to buy technology, the market leader at this point? I mean, at this point, don't you want to buy the areas of growth that are...
When you say technology, though, what do you mean?
I mean, S&P 500, S&P 500 technology sector. Let's start with that, because there are a lot of people out there who are exposed through an ETF, or anywhere else you want to go, anywhere that has sort of this notion of idiosyncratic growth. Environment where growth
see, those are the names that I would stay away from, right? Because if we're starting to see growth throughout the world come back, you don't necessarily need that idiosyncratic growth anymore. You need companies that are going to be exposed to the global growth, companies that are exposed to the cyclical upturn. So you might see a rotation. That's what we've seen a lot of this, even near the lows. And when everybody thought the economy was going to recession, you saw a bid in Apple and some of these names because they had that idiosyncratic growth. So I think here you sell those, and if you really want to be long, maybe you do buy some of the banks, something like that.
But Mel, this goes back to that January 2nd. What happened that day? Apple told us that their earnings were going to be down, that this is going to be the first year in many that their earnings and sales were going to be flat, to down year over year. We know that it's the third consecutive year that their units of their iPhone, that they get 2/3 of their sales. My point then was that coming into the year after the sell-off that we've had with expectations in November and December coming down massively for the first half of 2019, that sets up really well as it relative to expectations. But it's also really important to remember, as we're focused now on earnings guidance going forward, that Apple told us that China was bad. I mean, this was in the throes of this kind of recessionary period. So maybe we were way too negative back then, and maybe we're way too positive right now.
Let's talk about, let's think about the earnings that we have so far. And granted, it's early in the earnings season, but what are we learning about the U.S. consumers so far and companies? We're learning that companies are able to raise prices, right? Procter & Gamble raising prices, Coca-Cola raising prices, CSX raising prices. Aren't these all good things? So there may be growth may be challenged. You may perceive growth to be challenged, but companies are better equipped to handle this.
Yeah, I mean, I like today that there was broad beats in different sectors. So that was interesting. However, at some point that's priced in. And I'm starting to think it's getting to that point where it is priced in, which doesn't mean I'd be like a wholesale seller of the whole portfolio. It just means I'm probably not initiating new positions and I'm taking some money off the table. And in terms of the idiosyncratic ones, those are priced so expensively. Some of the huge growthy stories. I mean, something like a Zoom, I just could never get my arms around that kind of valuation. I'd much rather be in something way more value-oriented.
Don't you think it's a little coincident, though, that we're literally on the heels or on the cusp of a $100 billion market cap of Uber coming to market? You just mentioned Zoom. We have Pinterest. We have Lyft. We have all these deals that are coming at a time now. We're back to these prior highs where valuation will become a concern. So some of those names that we just talked about, those old mega caps on a on a relative basis, they actually may look attractive. You know what I mean? So to me, I actually think the Uber deal, when this thing comes in the next few weeks, is going to be a very important test for this market, especially when you consider how many tens of billions of new issues have just come and how many are expected to come after Uber at a time where investors are all of a sudden really, really complacent. To me, I think there's
test in what way? What are you looking for?
A test of what sort of hands are holding these sorts of things, right? We saw Apple go from 230 down to what, 140 or something like that in 3 months. I mean, so if you don't think that Uber could lose 50% of its market value at some point in 2019,
so if Uber traded like Lyft, let me ask you, if Uber traded like Lyft, what does it tell you about the market?
I think that'd be a real problem. I just do, you know, and those are losses that people have to kind of digest here and now.